just intuitively, it doesn't, this what makes me nervous. It's hard to think you had the greatest asset bubble in the history of the world, and then fueled, with the cherry on top by COVID, and 11 months of a bear market's all you get. Right? We're still above pre-COVID levels in everything. What people often miss is Bitcoin's way above. Like everyone says, oh, crypto sucks. I'm like, what are you guys talking about? Bitcoin has way outperformed all growth stocks during the, pre-COVID to now.
Oh yeah, by a long way, massively.
Listen, our industry needs a colonic.
When it comes to the macro environment, Genuine Vision, who was discovered in a Raoul Pal, is an expert. Raoul not only ranks among the world's foremost authorities on macroeconomics, but over the past 3 years, his forecasts of how macroeconomic conditions will affect the financial and cryptocurrency markets have also been remarkably accurate. Raoul recently spoke with Mike Novogratz, the CEO of Galaxy Investment Partners and an American businessman and billionaire. In the conversation, they discussed their skepticism about whether or not the recession is truly over, as well as their predictions for how the macroeconomy will develop in 2023. Keep watching until the very end, because that's when they explain what all of this implies and how it will influence risk assets, particularly cryptocurrency. If you like finance-related content, consider subscribing or liking the video. Yesterday, he went out with investors and Dave Tepper, one of the greatest traders in history. Both of them are aware that a few things are correct, but it is complicated.
I was out with one of the world's great traders of all time, right? Dave Tepper, yesterday, and investors. And it's complicated, both of us. So we know a few things are happening, right? China's reopening, and we know what happens when you're reopening. There's a consumer surge, there's a travel surge, there's a, it's good to be alive surge. The animal spirits come back. I think Xi showed his stripes during the spontaneous, those protests 3 months ago were shocking in that they were all over China, and they were angry, and they were young and old and rich and poor. And Xi wants to be emperor for life. And he was like, uh-oh, I need to make some changes. So real quickly, let's rewrite the script on COVID and go to forget COVID zero. But also, let's back away on regulation. Let's let people make money again. And so you've seen Alibaba and lots of tech stocks, come 50% off their high. But I'm hearing over and over, the environment's going to be more business friendly than it was even 2 months ago. And so you've got China, hopefully good for crypto, but China good for
because they've reopened Hong Kong essentially for crypto, which is interesting, right?
Yes. So good for the global economy, good for commodity prices, copper, we're on copper and oil. You've got Europe, which was fearing the, ice planet Hoth from Star Wars, right? They cut a tauntaun and so, weather has really bailed out a European recession. We might not even get a European recession now. And so you got to get a resurge there. Japan is booming for the first time in a while. Economy's strong. You had kind of a wacky BOJ last night. So the U.S. is slow, but the consumer isn't. Employment's still strong. I have a friend who's got 6 businesses, and he said, 5 of them suck, but my hotel business just doesn't. It's defying gravity, right? High room rates and full occupancy. And if you come in New York, it's hard to get into a restaurant on a Wednesday night. Forget a Friday.
Yeah, we've got here in the Cayman Islands the busiest January on record. It's all Americans.
Yeah.
I'm like, wow, it's supposed to be a recession.
Well, if you look, so what's so interesting about the response to COVID in America was how fast it was. There was not a day where personal incomes went down. Not a day. COVID happened, we're giving you money. And we gave you a lot of money. So income growth went way up during COVID. Savings went way up during COVID because you couldn't spend anything, right? You could, go on Etsy and get a potholder maker, build a sweater like this one, or, paint your house and order a new refrigerator. But broadly, savings went up. it started coming down, and Biden got elected, and they turbocharged it because the Dems, the progressives said, this is our turn. And so let's do that other $1.8 trillion stimulus that we didn't need. And this is for PPP. Like at school, COVID was almost over, and we're now giving like billions of dollars to schools for PPP that no one wants. But all this money pumped into the economy. So personal incomes went way back up. Savings rate went way back up. That's been falling. Savings rate's now negative, but the pile of money isn't gone yet. So while the savings rate is negative, the net savings is still positive. And so you're seeing credit card debt starting to pick up again. So we're going to eat through that, but we haven't eaten through it yet. So until then, let's go to the Caymans, right? Let's go out to Nobu and or buy something at Louis Vuitton.
Well, do you think we go into recession, or do you think we avoid? How are you thinking of?
I think we go into recession because that savings will evaporate. Negative savings rate by definition. You're seeing layoffs in lots of big companies. We had a wage surge. It's coming off pretty quick, right? And so my guess is we at least have a mild recession. And that, that the Fed raises 25 next month or in 2 weeks. And then that next meeting probably raises, but probably shouldn't.
Yeah,
right.
I agree.
But there'll be a debate, right? Why macro is tough is, let's assume that's the truth in the U.S. If you start seeing China come back and Europe doing better and global commodity prices, we can get inflation down to 3.5%, 4%, from whatever 6%. But can you get it to that next level down to 2%? And does then after that pause, we're always used to pause cut, right? The market's pricing in pause cut. And that's probably what happens. But there's another side of your brain that's saying you could have a reacceleration, right? So that story, and I think that's why, again, my buddy said, I just might not invest this year. It's that complicated of a...
It is complicated, right? I'm like you, I'm kind of more of a deflationist, and I think over time it probably comes lower. But there's this other distinct probability that things come back too fast and we create inflation again. So I'm not sure how much rates come down. Sure, the 10-year can come down a bit in the meantime as growth comes down. But do rates come down a lot, or do they cut them down to 3 and then they get stuck?
So if they cut, they're not going to cut 25, right? They'll cut 50-50 and then see what happens. And so, the market's not that unfairly priced. If you think 25-25, wait 5 months and cut 50-50, that would be the normal pattern. But there's a shot at 25-25 and they wait and they're like, well, until we really see inflation going below 3.5, let's just sit here.
But if they do that, so I've been talking about this with people because there's a lot of people think there's a second surge of inflation, and the Fed kind of think that. So like, we're going to stay. So therefore they're guaranteeing there's not going to be the second wave of inflation, and therefore 10-year yields collapse, which is very positive for the risk asset space that we all love.
Yeah, so that's, listen, there's this balance between, so Powell embarrassed himself by being so late to hike. And there was some strategy there. He wanted to get reelected, period. He wanted to get reelected because he thought he was the right man for the job. He didn't want Leo Brainerd in the job. He thought he was the guy to take the Fed through this hard times. And if that's a good strategy or not, that was a strategy. And so he definitely doesn't want to be seen as Arthur Burns, right? And so I think they're going to they're going to talk hawkish, and they're going to be hawkish. And they've been kind of bailed out by this tight labor market, now they're going to get the global growth. And so, they're softish landing it. In some ways they're doing a really good job. Stock market's at an okay price. But people aren't through that transition yet. Like, your LIBOR plus 100 loan that you were making investments with, 1% is very different than 5% or 6%. And so I do think levels matter some. They don't matter as much as rate of change, but I do think they matter some. Literally since 2007, not a serious adult, non-professional, but like mom or dad, should have bought one scintilla of fixed income. Not one. And so this is the first time people are buying, say, hey, I can actually buy New York munis at 6% and or treasury bills at 4.5%, and so fixed income is becoming a real asset allocation to just normal, wealthy, not so wealthy, savers. And that's a shift, right? And so I don't think, unfortunately, growth comes back screaming, right?
No.
Like that was fueled by cheap money. That I think is just going to be a reality for a while. What would change that? Not a lot. You would have to literally see kind of a global catastrophe and, the deflation tornado come back. But that's just so hard to see given the structural shifts that have happened.
Yeah, and I think a lot of people aren't talking about what does GDP look like on the other side of this recession. I think it's probably slow.
Yeah.
Because if you say if the Fed keep relatively tight, the economy's slow, and that's a different world to deal with. It's not as easy.
Thank you guys for watching.